terms of talking to people and saying follow the herd, you never want to be a follower of the herd. Occasionally it works. It gives you a false sense of security. Generally, when you're following people, you're going to end up losing, especially when it's the herd mentality. The smart money gets in at the beginning of the run, the dumb money later on, and you never want to be in that crowd that's chasing at the end. So avoid the hype, essentially. And I think it's important to recognize that what was going on over the summer is number one, the markets had started to bottom, and we started to have this kind of turnaround in the equity markets where it was becoming a risk-on environment. And what you notice is the meme stocks ran just at the end as the S&P was topping out here. And if we go to the S&P chart, it's getting crushed today again, just like it did on Friday. But look at the chart here. I mean, this is the beauty of the charts, David. And I know you know I'm a technical chartist, but look at the level we ran into. We had this monster move up right to the 200 moving average, right to this downsloping trend line, and right to this gap fill. I call that a 3-factor resistance line. And that is a beautiful thing. It basically choreographed we were going to roll over, and you can see the meme stocks kind of ran into that. And then we've seen that fall as well. So again, the charts tell you a lot about what the probabilities are. And they were saying we were going to come down or start to fall in the markets. Look at the 200 moving average here. And this is the key, folks, is that if you're in these trades, that's all fine and good. And if you're in the money, there's no reason you have to get all the way out. But what you want to do is you want to play it smart. You want to take a little bit off the table. As you hit a resistance line, take a little bit off. When you hit the next one, take a little bit off. So in this situation, at the 200 moving average, that would have been smart to take a little bit off the table, and then you can let the rest run. And then what I want to show you here, and again, I'm just looking at this, but look at this trend line here. I mean, really, you had a great trend line connecting these highs, and really right around there is where you saw it stall out. So the 200 MA right here, you just kind of take a little bit off. And what we say, you know, in the crypto markets, it's called a moon bag, where it's kind of all just the profit at that point. That's fine if you want to leave that on the table. I don't like to do it myself because I like putting money and banking it. But again, at least in that scenario, you're taking some off the table, taking a little bit more, and you're lowering your risk as these stocks get more into ludicrous levels. Channel. So look at the beauty of this channel here, how we've been hovering up and down inside of it really since June. But the negative here is that we saw a close below. Now you haven't confirmed, but as far as I'm concerned, this is a very, very nasty little pattern formation. And it's likely we're going to go retest this yellow trend line here, which happens to be the high from 2017 right here. That's going to be a big line in the sand. If we break that, then you see that move down that I've been calling for as my secondary target. You know, my first target was 20,000. We talked about it last year in Dubai when I was there in October 2021. We said 20,000. Now I say it's going to actually go lower than that. Next stop is going to be 12 to 13,000. So we are headed lower, and it's going to be a rough road along the ways here. So the beauty of 12 to 13,000, it gets us to that 80 to 85% correction that Bitcoin has done every single cycle. So that kind of gives us a basis of what to look for. It's also a strong technical support. But you're right. I mean, if you're a long-term investor and you're not going to look at it for 10 years or 5 years, there's nothing wrong with that. You just have to, this is the key, right? You have to be able to weather the emotional storm, because I know a lot of investors out there, they might buy in at 22 or 21. And when they're down 40% at 12, they might panic and unload, because you're going to hear a lot of negativity out there. And if you have to be able to control that and shut it out, and then you're okay to do that. But if you're someone who's very emotional and you're going to exit the trade at that point, and then it goes to 50,000, then 100,000, that's not a good scenario for you to be in. So if you have emotional control, that's fine. Start inching in. I also advocate for dollar cost averaging. Buy a little here at 21, buy a little bit more at 18, buy some more at 15, and so forth, versus just going all in at one specific level. I'm in the camp that we're going to see crypto sell off with the stock market. I have a big downside move coming later this year in the stock market, and that's going to be the catalyst to really take us to that 12, 13,000 marker on Bitcoin. And I actually think that Ethereum is very likely going to head down to this next target around $645. So I have it priced in. That should be the level that Ethereum hits when Bitcoin hits 12 to 13,000. Key major support, it was the beginning of the big bull market. This would be 100% retrace to the start of that bull market. Major support right here as well. Bitcoin chart, you can see here, we haven't even come close to the 200 on Bitcoin, which is kind of sad to think, right? I mean, it hasn't even come close at all, but you can see right here, it did hit the 200 before that next cycle to the downside. The problem here on the Bitcoin chart is that this was a very defined bearish pattern, and now you're below it. So that is problematic. Now, again, we have to hold this 19.6, 19.5 level, which is that key level from 2017. Otherwise, again, we should be heading very, very quickly. And again, just watch the stock market. I strongly encourage everyone to just keep an eye on the stock market. That is going to be your indicator. If this continues and we continue to see this fall on the S&P, I don't believe that the crypto markets can withstand that. Yeah, so this is again a fear of the Fed not loose or not backing off. We got the minutes last week from the Federal Reserve meeting. That kind of was the end of the move. Right into those minutes or when we touched the 200 moving average, which was the technical resistance level. And then as soon as we heard from the Fed, it didn't seem as they were as dovish as the market wanted. And we've seen the dollar just soar here. Take a look at the DXY chart. Let me punch that in here. And we've seen the dollar basically up to a double top up here. But look at the run on the dollar basically since that move from the Fed or since the minutes came out. And that is putting major pressure. The stock market does not like a strong dollar. It wants a stable or slightly weaker dollar. And that, again, is problematic here for the market. So as long as the dollar is going higher, it's telling you that, again, investors are moving away from stocks. And that's why we're seeing the selling that we're seeing. If you sell in terms of yen or euros, and then you convert it back, right? So you're taking in yen or euros, and between that period of the conversion back into dollars, the dollar strengthens. So you're actually getting less out of it. And we've seen even stocks like IBM, companies like IBM, they took a $3 billion hit because of the currency issues here. So it's kind of wacky how that's working right now, but it is definitely a headwind. And I think it's important to understand, what does a strong dollar mean? It means people are going into the US dollar for safety. And what they're doing here is they're saying, all right, the Fed is going to drive us into recession. And therefore, they're not lightening up, even though we know the economy is weakening per economic data. And so they're hiding in the dollar. They're selling risk assets that might be affected by a weaker economy. And that, again, is a kind of an issue that the markets are very freaked out about right now. No, I actually think the dollar is near the end of its run. If we go to your weekly chart here, I still have these two trend lines, which we're now retesting. You've got a double top in this vicinity. So I'm actually in the camp that in the near term here, we're going to start to see the dollar roll back over. It's way too short-term extended. I've loaded up on some gold recently, on some gold miners recently. Newmont mining is looking very, very attractive down here. So again, we can see, look at Newmont in terms of this. Let me get rid of the 200 moving average. But look at this channel on Newmont here, this pivot here all the way up, and then this pivot on the bottom just connected through. And look at what we touched on Newmont at the lows today, right at that level. So that's a good level, in my opinion, on Newmont mining. And again, gold, kind of the same thing. We had this nice move up recently on gold, and now it's retracing back